What if I told you there's a way that you can beat the banks at their own game? That's right, you can actually outsmart the banker. And I don't mean the person in your family that's playing the banker when you're playing Monopoly, right? I mean the actual banks where they're paying you nothing, but you're paying them a lot higher return, aren't you? So how do interest rates work in savings accounts? And why should you avoid savings accounts unless you are the bank? So I'm gonna answer all those questions and more in this video. Now, stay tuned, because at the end of this, I wanna talk about a strategy that even banks have used themselves that you can use to reverse the role and make it work better for you. But let's just get rid of the basics, right? Why do banks pay you interest? Now, many people don't believe this because there are people out there that'll tell you that debt is evil, that you should never have debt. The Dave Ramsey advocates of the world are saying debt is bad. Well, if debt is so bad, why is Dave Ramsey telling you put your money in a savings account at the bank? Or telling you put your money in mutual funds, which is also another bank? Well, what do you think they're doing with that money? Do they just take your money and let it sit on a shelf and collect dust, and then when you're done, they take it off, they go, here you go. Here's your old, stale, moldy money that you left with us years ago. Is that what a bank really does? No, of course not. We all know differently. Heck, I've even had 18-year-olds who've never set up a bank account know that banks make money from your money, right? So why do they pay you interest? Because they want your money. And they want to incentivize you to keep it with them and keep it with them forever. They want you to put money as often as possible, keep it in there for as long as possible, put as much in there as possible, take as little out as possible, and of course, let you take all the risk while they take none of it. That is the perfect banking model. Just so you know, those 5 rules should be the rules you follow with your own money if you want to reverse the rules and take it back on them and beat them at their own game. Remember, you want money as often as possible, you want as much of it as possible for as long as possible, have to pay as little back as possible, and of course, take as little risk as possible. High risks do not create high returns. That's a lie that also bankers have taught you, so you take all the risks so they don't have to, right? So they make interest because they're taking your money, they pay you .nothing% in your bank account, and then they turn around and go lend it to you or your friends or anybody else out there at 3, 4, 5, 10+% interest. Whether they're loaning to you back as a car loan, a mortgage, credit cards, business loans, whatever, they're loaning it back to you at a much higher interest than what they pay you. Now you're thinking you're all grateful because they've paid you 0.1% for the last couple years. You're thinking, oh, it's so nice for the bank to pay me, let my money sit around. I did nothing for that. This is awesome. But in truth, the bank is saying, you ignorant moron. Thank you so much for letting this money sit here forever so we can make money on you forever. By the way, if debt were so evil, you would have banks calling you up and saying, hey, Mr. Client, you know what? I appreciate you doing business with us for so many years, but we just looked at the interest we've been paying you and it's horrible. I mean, do you know what kind of interest we pay? I hate being in debt. We listened to Dave Ramsey's show and he told us we should be debt free. So all of us bankers are now gonna pay back all those savings accounts, pay them off because we wanna be debt free. Have you ever heard a bank call you up and say that? No, because that's stupid. That's dumb teachings. They want you to keep your money with them so they can pay you more. Heck, even if you put your money in a CD or a certificate of deposit, they'll pay you a little bit more. Why? Because they're like, hey, I can lock up your money for 3 months, 6 months, a year, 5 years, and your money gets locked up. And if you try to pull it out early, they charge you interest. You don't get paid interest on that money. So you're incentivized to keep your money locked up. And they're saying this is great because, hey, if I pay you 1% for your 5-year CD, or even 2%, no problem, because I'm making 5% on that 5-year car loan that I just lent that money out on. So thank you so much, right? That's how the banks are making money off of your savings. And that's why they love paying you interest. Now, the big thing you have to understand too is there's compounding interest versus simple interest, okay? Now, when you have money in the savings, it's compounding interest. On a loan, is simple interest. So one of the key things you can do is you can actually use debt to your advantage. Now, I'm gonna say this with a big warning, right? Big warning for you. Do not do this if you're an uncontrollable spender. If you need some help group like Spendaholics Anonymous, this is not the strategy for you, okay? If you're also a gambler, you're someone who says, I wanna do the next biggest deal, and you just throw your money at whatever opportunity comes your way or whatever shiny object, this is not for you. This is for those of you that either have been 1, good savers, or 2, you're someone you like to make wise investment or business decisions. This could be the best thing ever. Now, those of us in business have already done this. We know if we borrow money, we want to make more money than it costs us. For example, when I launched one of my first businesses, I got a $25,000 SBA business loan from the bank. That $25,000 line of credit cost me a whopping $130 a month. Now, I don't know about you, but if you're somebody that's starting a business, if you can't turn 25,000 into at least 130 bucks a month, you should never start a business. You should just stay as an employee and make more money there than you will in your business, because you will just drive yourself silly and go insane, right? But $130 a month, any of us that are in business know, I will take that money all day long. We know we can make more money off of it. The banks are doing the same thing to us. Why don't we do it back to them, right? Also, same thing as an investor. I love borrowing money to be able to use it. I borrowed money from my home equity line of credit just a few years ago on our house and used that to go buy real estate. The cool thing is that the real estate overall has averaged over 20% per year. It's actually been close to about 30 or 40%, but I don't want you guys to say, oh yeah, you're lying, Chris. No, I'm not. If it made 300% in 4 years, you do the math, okay? Either way, I made a lot more than the 4% a year we were paying the bank. A lot more. Even if you do the math over a couple of years, if I paid them 8%, I don't care because I made 300%. That makes sense, okay? Now here's something that many people don't understand that banks do, and this is where banks have leveraged it. There's compounding interest and there's simple interest. Now, simple interest is the money you pay on a loan. As you pay down the loan, believe it or not, most people think that somehow the banks created some crazy interest scam, right? That makes you pay all of your interest up front. And that's where you get ripped off. The truth is, it's just math. It's just numbers. You pay more interest in the beginning. Why? Because your balance is higher. But when they make you make a monthly payment, you pay down some of your principal. So the balance comes down, meaning the interest you pay comes down. So it's not that you're getting ripped off from some magical number. It just means that interest over time goes like this. It's like that inverted curve, right? It goes down over time. That's why towards the end of your loans, you pay almost all principal and no interest. It's the same monthly payment. You're just paying down the balance with that extra money. And then there's more extra money being used to bring that balance down. Where compounding interest, like money you have in savings or in other types of investments, it sits here, but it grows and then it exponentially takes off over time. It has this exponential effect. Just so you know, these two interest rates are not the same. I want you to do this. You can go find any online calculator for free. I mean, you can go to like calculator.net and figure this out. But look up doing a 5-year car loan at 5% and look at, there's a monthly payment there, but look at how much interest you pay over those 5 years. I promise you, say that it's a $10,000 car loan, right? And that's at 5%. You'd think, oh, that's $500 a year. Nuh-uh, it's actually less. You pay a lot less than what you'd think would be $2,500 because the interest goes down. But $10,000 invested, look this up. Do it at 3% compounding interest after 5 years on $10,000 and see what happens. You'll start to realize why those of us that are wealthy don't mind getting bank loans for buying cars. In fact, we welcome it because we know if we can earn more interest. That 3%, just so you know, spoiler alert, 3% compounding interest beats 5% simple interest after 5 years. It beats it. There's more interest earned there than here. Why? Because compounding interest works more than the interest that goes down. They're not the same. In fact, if you want to see the break-even point, just put in that same $10,000, 2.5% interest compounding versus the 5% interest, and you'll see the numbers are almost exactly the same. So it means this. If you want to beat the interest rate that the bank is giving you, if you want to beat that 5% loan rate that they're giving you on that 5-year car loan, you just need to take that same money that you would have used to buy the car in cash and make at least 2.5%, and you won. So there's a huge bonus for you. That's the beauty of why compounding interest is huge. This is why also I use a strategy called infinite banking. And this is a big bonus for you guys because you can actually use what's a whole life insurance policy, not your typical term insurance policy. You can't do anything with that. You have to die to get paid. I don't recommend dying to get paid, okay? Whole life actually gives you life insurance, but there's a tax-free savings account that's a part of it that grows with compounding interest. The cool thing is you can actually get the insurance company or the bank to give you a line of credit, to give you a loan against that cash. So the cash is the collateral, they give you a loan against it, the money's still in there growing and compounding at 5 or 6% a year tax-free, while you're able to borrow that at right around 4% right now. So guess what? Now you're only borrowing at 4% simple interest, and just so you know, there are no monthly payment requirements. You can pay it back however, whenever you want, just as long as you pay it back by the time you die, which means your death benefit, your life insurance pays it back. So you don't have to pay that either. The life insurance does it for you. But think about it. Even if you earn 5%, you pay 4%, You just made 1% interest, and then you can take that money and invest it somewhere else, making, like in my case, we want to make at least 10, 12% a year. That's our kind of baseline that we like to earn. If I'm going to make 12% on my investment, if I use my life insurance to use that instead of my savings account, guess what? I make at least 1% a year. And because it's compounding, it actually ends up being much, much more. I even have another video on YouTube where I actually show how you buy an apartment building at $250,000 in over 9 years, make about $140,000 more in interest than you would just using your savings account. Huge. So anyways, I would love to hear what strategies have you used to help make money off the bank? How do you turn the rules back on them? I'd love to hear your ideas. And if you like this video, check out why is interest so low on savings accounts right now.